So what would this 200 billion do? Well, let's think back to the most recent quantitative easing that we had, and that was during COVID, right? Around March of 2020, I believe, is when, the Fed dropped rates immediately and started purchasing both mortgage-backed securities and treasuries. Now, that package was, at the height of it, was $120 billion a month. 40 billion of that was purchasing mortgage-backed securities, and the difference was purchasing treasuries. So we have some historical data here, but we're talking $40 billion a month for an extended period of time. This time we're talking about just $200 billion. So my first question is, well, how would that be deployed? And if you look closely at some of the comments that were made by Bill Pulte, after Trump made this announcement, which I think it was just a tweet or a message on either X or True Social or something, which seems to be the way that we get these comments these days, which is crazy to me. But nonetheless, one of the things that Pulte said in an interview was that it would be an accelerated deployment of those funds. And so I think that leans towards this being shorter term, but more money per month. So I would estimate that we're looking at 25 to 35 billion a month of purchases for an 8-month period of time. I think that would have a pretty meaningful impact on interest rates. Now, keep in mind, just like when the Fed lowers rates, we've talked about this a lot, the market starts pricing this stuff in, right? So that's happening as we speak. It's been happening since the day this announcement happened. The rates have already come down. And so this is already starting to be priced into the market. So if this doesn't come to fruition, you'll expect rates to pop back up immediately. Depending on how they actually end up executing this will dictate if the kind of futures estimates that were made now end up being reality, or if we see further improvement in rates. But my guesstimate is 25 to 35 billion of purchases, which is pretty substantial, but for a shorter period of time, like 8 months. Now, keep in mind, Jerome Powell's out in May, I believe that it is. And so, I think the thought is this gets us to that point, and then we can get a new chair, and maybe we can get some more, aggressive means of doing something with interest rates. Now, This concerns me. I mean, look, I'm in the mortgage business, so I kind of love this idea, if I'm being honest, but it concerns me because isn't the Fed supposed to be independent? It sure seems like there's a lot of leaning here on influence from the Trump administration over the Fed. So that's a little scary, I'll be honest with you. But I'm just reporting the news here as I see it and my take on things. Now, let's just say that they did a more relaxed purchase. Let's just say they spread it over a 12-month period of time. If it was 12 months that they deployed that 200 billion, you'd be looking at something more like what I estimate 16, 17 billion a month in purchases. Still substantial, but less than half of what they were doing back during COVID. And keep in mind, what that did is that took rates from somewhere in the mid fives down to the low threes. So we don't expect that to happen, but we do think that this will be meaningful for rates, and we're already seeing the benefits of it.